always honored and delighted to address this group. No, it's not, which one?
No, not here either.
Is that, can you hear this?
Yes.
Put it a little closer then. I'm honored and delighted to be here. Is that good?
That's better.
Throughout my public career, I've always viewed consumer protection as the core of what I do. And I have long admired your effective advocacy and all that you've accomplished over the years. Regardless of the issue, whether it's housing finance, consumer credit, payday lending, auto insurance, there is no stronger voice for the hardworking public, the Consumer Federation of America. Perhaps your biggest accomplishment came just a few months ago when you helped us win passage of the Dodd-Frank Financial Reform Act, closing the books on the doctrine of too big to fail and creating a new consumer watchdog for financial credit products. Our 2 years of hard work and persistence paid off, and it's now up to us to ensure that the new law is implemented strongly and fairly. What I would like to do this morning is outline the rationale for the new reforms and the way forward. Aside from the CFPB, many of the reforms might not at first blush appear to be relevant to consumers, such as the FDIC's new resolution authority for large institutions or the new Financial Stability Oversight Council. I admit they can be arcane and as difficult to understand as the terms of your credit card statement. In fact, most, if not all, of these reforms are vital to protecting the financial well-being of every American and the broader public good, whether it's preventing another massive bailout shouldered by all taxpayers or preventing a foreclosure that should have been a modification for a family. The mortgage crisis points to the need for leveling the playing field between banks and non-bank providers for consumer lending. The lack of sensible, consistent mortgage lending standards and consumer protections in the run-up to the crisis ended up destabilizing housing markets and the entire financial system. This race to the bottom mentality imposed large losses on banks and non-banks alike and imposed long-term damage on household balance sheets and consumer confidence. The CFPB provides a real opportunity to simplify consumer rules and make them work in the interest of consumers. It subjects non-bank financial providers to more rigorous rules and examinations while enhancing the competitive position of responsible lenders, including many community banks who are trying to do the right thing for their customers. I welcome the addition of the CFPB director to the FDIC board. This will help to not only enhance the FDIC's strong reputation for consumer protection, but also give the CFPB some insights into the wide range of depository institutions with retail operations. The financial crisis also has exposed other critical flaws in how our financial system operated and was regulated. The reforms authorized under the Dodd-Frank Act include far-reaching changes to restore market discipline, internalize the cost of risk-taking, and make our regulatory process more attuned to systemic risk. A key reform is the new resolution authority for large bank holding companies and systemically important non-bank financial companies. This new authority directly addresses the dilemma we faced in the fall of 2008 when a number of these companies ran into serious trouble. We all saw the result of the Lehman bankruptcy, which threw global financial markets into chaos. In contrast, the FDIC regularly carries out a prompt and orderly resolution process using its receivership authority for insured banks and thrifts. The Dodd-Frank Act, for the first time, gives the FDIC a similar set of receivership powers to close and liquidate systemically important financial firms that are failing. Let me briefly describe to you the practical significance of this new resolution authority. In the old world of too big to fail, risk-taking was subsidized. Systemically important companies took on too much risk because the gains were private while the losses were absorbed by the government. Market discipline failed to rein in the excesses of these institutions because equity and debt holders, who should rightly be at risk if things go wrong, enjoyed an implicit government backstop. This skewing of financial incentives inevitably leads to a misallocation of capital and credit flows. During the boom, too much credit was directed to single-family housing when it might have been put to better use in other sectors. And much of that credit was structured in ways that did not meet the long-term needs of household borrowers. But implementing the new resolution authority and ending too big to fail is a game changer in terms of economic incentives. It is the key to restoring market discipline on the nation's largest financial institutions and better aligning their financial incentives to control risk. Capital and credit will be allocated more efficiently, and taxpayers will no longer be on the hook when these companies get it wrong. The task that now falls to us as regulators is to promptly and effectively implement these reform measures. The FDIC has created an Office of Complex Institutions to work with our counterparts in monitoring systemically important institutions and seeing that they establish credible resolution plans that will ensure that they are not too big to fail. They need to clearly lay out the structure and